What if I told you there's a Singapore-listed company sitting on more cash than its market cap, earning consistent profits, and trading at just 0.57x book value? Meet PSC Corporation, the hidden engine behind household brands like Royal Umbrella Rice, Fortune Tofu, and Beautex tissues. While the world chases flashy tech stocks, this consumer staple quietly dominates supermarkets and is expanding into coffee and e-commerce. In this video, we break down PSC's financials, its growth strategy, and whether it might be Singapore's most undervalued stock. PSC Corporation, ticker symbol DM0SI, is one of Singapore's oldest consumer goods companies, with a 50-year legacy in essential products and an expanding footprint across Southeast Asia and China. It operates in stable, recession-resistant sectors. Yet today, it's trading at dirt-cheap valuations. But first, a quick disclaimer: this video is for educational and entertainment purposes only. It does not constitute financial advice. Please do your own due diligence or speak with a licensed advisor before making any investment decisions. PSC isn't just one business. It's a consumer staple conglomerate made up of three main divisions. First, the Consumer Essentials business, which contributes 48.1% of group revenue, or 234.8 million Singapore dollars. This includes FMCG distribution in Singapore through Top Seller Private Limited, FMCG distribution in Malaysia via SOCMA Trading, in-house manufacturing under household names like Fortune Tofu, noodles, Asian desserts, and Beautex tissue. And in 2024, PSC acquired a 51% stake in Kim Guan Guan Coffee, entering the coffee manufacturing and F&B retail scene, with plans to expand into China. Second, the paper packaging business, contributing 51.9% of group revenue, or about $253.8 million. This division is operated by Tat Sung Packaging Group, with manufacturing plants in Singapore and Suzhou, China. To stay ahead, they're investing $9.3 million into a high-tech corrugator line to improve productivity and energy efficiency. Third, we have the e-commerce and retail expansion arm. In 2024, PSC officially launched its PSC e-store, offering direct-to-consumer sales, promotions, and loyalty programs. This marks their push into digital, building new touchpoints with modern consumers. Altogether, these three divisions generated $488.6 million in 2024 revenue. The takeaway? PSC is highly diversified, not dependent on any single product, brand, or market. Let's take a look at PSC Corporation's financials. In 2024, the company reported revenue of 488.6 million Singapore dollars, with net profit of 22.75 million. That translates to a profit margin of 4.66% and a return on equity of 7.32%. The company holds over $206 million in cash, more than its current market cap, and has a very low debt-to-equity ratio of just around 21%. Let's deep dive. PSC trades a price-to-earnings ratio of 8.39 times and a price-to-book of only 0.57. Its enterprise value to EBITDA ratio is just 1.42, indicating it's a net cash company. This isn't a company burning cash. It's consistently profitable, asset-rich, and has zero reliance on debt to grow. PSC is entering its next phase of growth on multiple fronts. First, the company's new coffee business, Kim Guan Guan, is targeting premium and decaf segments, tapping into growing demand for healthier, high-quality coffee options. They're also making a bold move to expand into China, leveraging their heritage branding and Singaporean quality as a competitive edge. On the digital front, the PSC e-store is gaining traction, enhancing their direct consumer engagement and improving customer loyalty. Meanwhile, the packaging division is investing in automation, upgrading systems to boost productivity, efficiency, and cost-effectiveness. And with over 27,000 retail points across Singapore and Malaysia, PSC has the scale and reach to support and accelerate these growth initiatives. The result? A company with strong traditional roots, now primed for modern, sustainable expansion. Let's talk about returns. In 2024, PSC paid a total dividend of 1.8 cents per share. That's about a 3.2% yield at current prices. And they've maintained this payout consistently, even amid global economic uncertainty. What's more, the company is sitting on over $206 million in cash, with a positive free cash flow of $29.3 million. Translation? You're getting paid while you wait. And PSC has the flexibility to either raise dividends or invest in new growth, all without diluting shareholders. So why is PSC flying under the radar? For starters, the stock is trading at just half its book value, an incredibly rare discount for a profitable, cash-rich company. Its EV to EBITDA ratio is only 1.42, which is extremely low for a consumer staple business. The reason? Almost no analyst coverage, meaning the broader market just isn't paying attention. And while others sleep on it, PSC is expanding into higher margin segments like premium coffee and functional health-based desserts. This combination of deep value and emerging growth makes it one of the most overlooked opportunities on the SGX. As with any investment, PSC isn't without its risks. First, the paper packaging business in China faces pressure from a weaker renminbi and industry overcapacity, which could squeeze margins. The consumer business, while stable, typically operates on low profit margins and is not immune to rising raw material and logistics costs. Another factor, liquidity. PSC shares are thinly traded, which means buying or selling large amounts can be difficult, especially for institutional investors. And finally, there's execution risk, particularly in their China expansion plans. Scaling a new market with premium coffee products requires strong brand positioning and operational excellence. So while the fundamentals are sound, investors should be aware of these key risks on the horizon. So what's the final verdict? PSC is a moonshot, but it might just be one of the safest value plays on the SGX. With recession-resistant products, dominant branding, and a fortress balance sheet, this is a company that's quietly compounding in the background. Here's what you're getting. White heavy checkmark undervalued earnings. White heavy checkmark brand equity that sells itself. White heavy checkmark hard assets and recurring cash flows. White heavy checkmark and now a strategic move into high margin F&B. If the stock simply re-rates to book value, that a potential 75% upside from today's levels. Bell, if you enjoy uncovering under the radar SGX gems like this one, hit subscribe for more deep dives. Thumbs up, and if you learned something new today, smash that like button. It really helps the channel grow.